Joining us now to help us explain today's moves and where the markets are headed is Jim Paulsen. As Chief Investment Strategist at Wells Capital Management, Business Week has named him a top economic forecaster. Bond Week has twice named him Interest Rate Forecaster of the Year. Jim, welcome back to Bloomberg News. Always good to have you on.
Good to be here, Mark.
Jim, before we get to Treasuries, I wanted to ask you about that consumer confidence number today, that unexpected drop. Were you surprised?
Well, by the magnitude of it, no doubt, but the direction of it, not so much. I mean, if you think about the fact that we had a worse than expected payroll number last month, we've had scary headlines out of Europe here going on. We had the oil spill in the Gulf. There's good reasons why the consumer might not be feeling as good lately, and indeed that's shown up in some of their spending patterns as well, that has slowed down a little bit. So
right.
I don't think it's that shocking. It tends to be a very volatile index, Mark, and it could pop back up again here in the next several months.
Jim, you just talked about consumer skittishness. It's ironic because consumers, and given the jobless number too, they may be a little bit hesitant to make that purchase. But as we've been mentioning for the past couple of days, nearly 2 million iPhones sold in just 3 days. Where's the nervousness? At $300 a pop, we might add.
Yeah, I was at the Minnesota Twins ball game last night. That was a packed stadium too. So it is kind of inexplicable, how you look at these different patterns. I think there's good reason. We had in March, we had the 10-year Treasury buzz all the way up to 4% and backed up mortgage rates back above 5.5%. Crude oil prices zoomed ahead earlier this year to almost $90 a barrel. The Fed was talking about tightening. So there were some things impinging upon the economy, which probably now have had some impact. They've slowed housing. They've slowed retail sales a little bit.
Right.
But the good news is, I think, is we're now looking at a 10-year Treasury below 3%.
Is that a sign of things to come, Jim?
Well, I'm hoping. I mean, a lot of people look at this Treasury yield as, what does the Treasury market know that we don't? And I'm a little bit that way. I have that same question. But on the other hand, I think this is going to do good things for the economy here over the next couple of months. Mortgage rates now are clearly down with 4 handles. Oil prices are back down to $75.
Right.
The Fed is a long ways from tightening. And I think as that feeds through into the economy, I think it'll help things in the second half rather than hurt us.
Okay, with that 10-year, as we mentioned, below 3%, does that also mean right now you're keeping your eye on the S&P as well?
Well, you think about it. We've dropped the price of the S&P 500 15% roughly from its highs just a couple months ago, while we've also taken a full 1% out of the 10-year Treasury yield, and for all accounts and purposes here, earnings are still rising. So there's been a heck of a revaluation of the equity market going on here on all 3 fronts: lower prices, lower competitive interest rates, higher earnings. I think if the economy shows some signs of ongoing recovery, you're going to see greed return to this market.
Jim, in what form?
Well, I think people have been bailing here in the last couple months. And they seem happy to be sitting in cash at 0 and buying up Treasury bonds at sub 3% rates. If the equity market shows some life again, I think people are going to be drawn back in to the equity market with some of those liquid balances now on the sideline.
And speaking of showing some life, there's that jobless number. I'd like to point out that in May, the average time of unemployment was at 34.4 weeks, and that was a record. But then you talk about the consumer and consumer sentiment. That joblessness is still hurting consumer spending, is it not?
Well, I am. As far as Wall Street's concerned in the markets, I'm less worried about the unemployment rate than I am about the rate of job creation. What the economy needs right now and what the markets need right now is some solid job creation. If we can produce 100 to 125,000 private payroll gain on Friday, that'd be a great start. And if we can continue to create maybe in the vicinity of 200,000 jobs in the last half of this year monthly, then I think even though the unemployment rate may stay high for a number of years, the economy will be growing. incomes will be growing, and I think that will bring consumer spending. So that's what we really need. And I think the fate of the economy and the markets in the second half of this year are going to depend upon whether we still have jobs being created and at what pace they're going to be created in the second half.
And Jim, lastly, in about 20 seconds, President Obama meeting today with Ben Bernanke in the Oval Office. The president talked about challenges the economy faces. He said headwinds because of that nervousness over Europe's debt crisis. Are we going to see a domino effect from there?
Well, it's a possibility. I think it's remote that we have a complete, freeze up based on fear, kind of like we experienced in 2008.
Right.
But that certainly provides an example, and you always worry about that when you see consumer confidence drop like it did here pretty precipitously this morning. I think the odds are the economy is going to turn out better than expected in the second half, and that'll revive some confidence.